Hi, I'm John. Can you hear me okay?
Yes.
The mic's working? Okay, good. Thank you for coming to our seminar today. These characters and I, we do work together quite often. We have a little company that we have called Best Practices Group. And I see them at least every 2 months, and then we talk practically once a week. And we've become very close as business partners and just partners in general. My background, as you heard some of that, I was a partner at Gray for 25 years or more. I kind of retired from that 5 years ago and started my own practice to do valuation services for the energy industry. That's really what I do now. I prepare probably 20 tax returns a year, maybe a couple more, with my kids, which I have quite a few of. And I do valuations for a variety of reasons. And you can come up with many of those. It would be divorce, bank financing, estate gifts, gift planning, succession planning, and some of the things we're going to talk about here. When I was getting ready for the seminar, I had lots of choices, and David Chu said, "Gee, I really want you to do, something about like we did in Connecticut last fall." But there was a spin that wanted to take place. So this seminar is about valuation, I guess. It's about succession planning, I guess. But really, I started to really dive into this retire rich thing. And the more I thought about it, the more I thought, gee, I got these little nuggets in my head that I would like to share with you all. And these nuggets came from primarily the best companies I've worked with over the last 35 years that I've been practicing. Because there's a big distinction between the really good and valuable and the okay, and then there's the really poor. But I wanted to focus today and just tell you some of the nuggets, and I think these guys have come up with some nuggets of their own that they've seen over the years. Because we go into companies to do either assess the value for a potential sale, or we go into because we're trying to do a succession plan. And when you think about it, those are almost two opposite things. I mean, when you build a business, you want to think about, just for a second, if I'm going to sell my business, I want to absolutely maximize the value because this is my inheritance, or this is my family's inheritance, or this is why I've done this for all these years. And if you're going to succession plan this business, either through gifts, estates, all that kind of stuff, or divorce, you want to minimize to a degree the value. So if you're the person who owns the company, or you and your wife, or you and your husband, or whatever it is, you want to minimize the value of this company so you don't pay a lot of transaction taxes on the succession plan. But on the same token, you want to get out what you need. And a lot of the plans that I work on, when the parents say it's time for us to step down a little bit, I still want to maintain some controls and things, but they need to come up with a value that's not going to just take money out of the family coffer, but we'll give them what they need to retire. I hope I said that clear enough. And there's lots of ways to get money or asset or value out of a business as you plan to retire. But these are the captions that I wanted to talk about today. In terms of valuation, customer list is my sweet spot. This is what I do on a regular basis. This is what I monitor on a daily basis for a variety of reasons. Bank financing being one of those big things. The bank comes to me and they say, "John, we need you to do this valuation for this company on the customer list because we want to lend against that customer list." And then the financial picture, I'm going to talk about that. Accounts receivables turn into it can be a pig and a poke. I want to talk some about that. We had part of our conference the other day was about that, and it can be pretty ugly, and it can put you out of business if you don't manage it well. Good equipment, I want to talk about that, and being competitive, and then lastly some tax elections. If you've ever been to my seminars before, customer list, as I said, is a sweet spot. And there's lots of ways to value a company. If you're a big acquirer, and you know who I'm talking about, you've done these transactions over and over. A lot of what you focus on is this thing called EBITDA, which is really the bottom line, adding back adjustments and things that don't require cash. And then you multiply that EBITDA by a multiple. And that multiple can run from 3 to, what'd you say the other day? 9 on a propane, or an 8 on a propane? 11, a what? 11 on one. 11, they had an 11 multiple on a propane company once. Doesn't mean it won't happen again, but in that, part of what I want to talk about is, well, how can it go from that to that? I mean, what is that difference? And that's what I want to talk about. That company becoming more and more valuable. But the other thing, if you're a smaller acquirer, and you're going to buy my oil company, I have 1 million gallons, I have 3 trucks, or 4 trucks, 4 vans, what are you going to buy? It's an asset deal. Customer list is the number 1 asset. Trucks and vehicles is the number 2 asset, inventory is the number 3 asset. That's what you're going to buy, or that's what you're going to sell. And so part of what I've always talked about in this customer list is quality of that customer list. And if you're buying my company and I have 10 automatic deliveries and the rest of them, 900 accounts, are will calls, then I'm not such a valuable company to you. I mean, that's not what you want, because you don't know what you're going to buy. But there was a company sold a few years ago that was 95% automatic deliveries. 80% of them were on budget accounts. 75% of them were on service contracts. A whole bunch of them were on tank guard programs. And a whole bunch of those were on automatic payment plans. Now that might be a credit card, it might be an automatic drafting. And when you've got that population of company, man, that's a sweet company. And you're going to get a multiple in that company, or you're going to pay a multiple to that company that's stronger than most. The other thing is the margin, which I've got here, strong margins for every product or service. If you're in Maine, for example, where the margins can be really skinny. I mean, I was talking to a company the other day, they were at 29 cents. I almost had a heart attack. And it was a nice people, nice company. And for Maine, maybe that's okay. And they told me that someone said their company was worth, it was a 3 million gallon company. They said the company was worth like $500,000. I was thinking, 3 million gallons? That's not right. Send me the stuff. And I looked at it, well, the margins that are so skinny, you don't even know if you're making money on a delivery. A lot of will calls, it was probably overvalued at 500, I don't know. I just wanted to get a feel for it because it was so uncomfortable. So, and then I have companies that are $1.05, $1.06 margins. A little more than that, we found out recently. And then I don't want to drop, I don't want you to forget about this word here, service. If your billable rate for your techs is $85, that's not as good as $115 or $125. If your service contract renewals are at $99 or $129, well, then you better be for practically doing nothing but a cleanup, or we don't call them that anymore. We call them what? Tune-ups. It better be for that. So, and then the service contracts, which you're here to hear and learn about. There's so many good speakers about service contracts and service agreements and how to write it and how not to and what it includes and what it doesn't. And the marketing of the service, it's a big deal. I mean, when you talk about quality of customer, it's a big deal. And then I put this little yellow thing down here that says tied to other services and features. And that's what I talk about, tank guard and payment programs. And I mean, there's so many ways to hook in that customer. Now, just to put this on the table, the biggest difference between a propane account, in my view, from a valuation person, and an oil heat account is that, for the most part, you own the tank. And that makes that customer locked into you. Versus an oil customer who can just call you and say, I don't want you anymore, hang up, and call Billy's Discount and start getting deliveries. I mean, it might not be that easy, but it pretty much can be. But a propane account, they don't have that luxury per se. Now, I have 3 houses, because I have an ex-wife and stuff, so I really have 2 houses left. But I have a house that's oil, I have a house that's gas, and then I have a place in New Hampshire which is propane. So I get to kind of feel all that stuff. My propane tank is always full, and if I want to get rid of it, it's going to cost me a lot of money. Plus, I don't think I get the propane that's in the tank. I already paid for it. So I'm sort of locked in, and I don't like my company. It's a mega company, and I don't really like them, and they don't really like me either. I'll say that right up front, because every time I send them a check, I put a note on the invoice, and I have things to say, feelings about it and stuff. So, but that's the point, is that propane accounts are locked in. That gives them the multiple. And when I value a propane account, just put this on the table, for the customer list, here's a number, plus the steel, plus the tank. So that's why when John talks about the multiple can be up to 11, or let's call it 9 or 8 to be more realistic. That's really the difference, because that tank, you own that tank. I love propane tanks as a CPA, tax person, because I got it, I paid for it, I depreciated it over 5 years, it lasts for 25 years, and when I sell it 15 years from now, the value at that point, 15 years after I put it in, is just like almost a new tank. When you say, oh, I've got 3,000 tanks in the field, and each size costs this, and plus the installation costs that, and so now I've got this $650 value that I put in 15 years ago that I wrote off the taxes, but it's worth $650 to the buyer, because it is. So I say all that. So that's customer list stuff. And it really is the biggest number on the balance sheet that doesn't even sit on your balance sheet. If you look at your company balance sheet, where's the customer list? Well, there's one. I see there's a line that says customer list. I'm a 30 million revenue company, and this customer list says $150,000. Oh yeah, I bought Joey's discount of Joey's oil company 4 years ago. That's what's left. That's all that's showing on that balance sheet. And yet, if you're a company of that size, there's a $6 million number that's not there. So if you're going to go to the bank and they look at your financial statement, they go, oh yeah, gee, there's no equity here. I mean, there's nothing here. I mean, you wrote the trucks off, you got receivables and cash, you got payables and a line of credit. Net equity, not much. And if your banker is not energy savvy, which most of them aren't, let's face it, they aren't. There are a few, but usually they go on to bigger and better things, and they're here somewhere. If they're not energy savvy, they have no idea that this customer list has value. Now some banks, I have clients, banks, People's United, Citizens, Citibank, there's a couple of banks that understand it, and they'll say, John, I've got this nice company, could you tell us what the customer list is worth? Now I did one the other day, it was $30 million of customer list. $30 million! I mean, I have to sign this thing, don't forget. You do though, you go through all the stuff and it comes to $30 million that's not on the balance sheet. That's an enormous number. And when you want to go to the bank for something, that's, to me, that's the first thing you need. That's financial picture of your company. Now, if you're going to a bank or you're going to do you're going to sell your company, which is something that we do quite frequently to help people to sell it, the first thing we look at is that balance sheet and the P&L. We look at these numbers, and they're usually pretty ugly. I mean, the company has been your company for a long time. Jimmy, how long have you owned your company? Since?
Let's see.
When did Columbus get?
And when was Noah's Ark?
Yeah. So you get the picture. So, and I don't know what his balance. Well, I do, but I'm not going to tell you. The financial statement looks terrible. There's stuff on there. I mean, every person who owns an oil company in this room probably has a boat on there, or an airplane on there, or a girlfriend's apartment on there. I mean, there's stuff. And then there's all the other stuff. I mean, it's like our little piggy bank, our little toy piggy bank. We put stuff in, we take stuff out, we suck stuff out, we do stuff. There's stuff on the books. I had a client who had this receivable, it was $3,000, and it was like old. I said, what? I said, Bill, what's the story with this receivable? He goes, oh, don't worry about that. That's Mr. I'm going to change the name, Mr. Jimmy's men's clothing store. He's a client, a customer. And I said, so why does he pay the bill? He goes, well, I think I owe him more than he owes me, and so we just kind of wash him off after a while. Now, this guy's a real sharp dresser, handsome, and got all the store, and the clothes are gorgeous. And that's how he pays for his clothes, through the receivables. I deliver oil, you deliver clothes. And then the second section of this is this potential sale. If you're thinking of selling in the next 3 years, let's say, because that's usually the window everybody wants to look at. It used to be 5, now it's 3. You got to clean up your act. You got to start getting rid of the personal expenses. The daughter that's on the books, the son who's a loafer and doesn't do his work and he's still on the books. My wife does the payroll and she gets $50,000 a year for that. My boat fuel's on there, my car fuels are on, and I have 6 cars with my kids. I mean, I got everything I have everything in there. Now you can't pretend to me and sit here and look like, I don't do that. Look, I own my own business too. I know how this works. You go to Costco, And I buy a case of coffee and for my clients, and guess who drinks all that coffee? Me. 7 cups a day practically. I mean, who's drinking the coffee? It's me. So you can't pretend that it doesn't happen. It does. And it's non-productive payroll. We ask our potential sellers, okay, we've got the P&L, what can we take out? Now, I had a company that did about $2 million a year in sales, and they guesstimated low that the personal expenses were 50 grand a year. So we kind of stick that in there because we want to add it all back. We want to come up with a great big fat EBITDA number. And this is one of the ways we do it. And this thing here, this stupid word right here, make a profit. You know, if you come to me today and say, gee, I really think I want to sell by the end of the summer. I go, really? Just like that, all of a sudden you're going to sell? Well, let's look at the numbers. There's no profit. Why? Well, you know, I don't want to pay taxes. Okay, but nobody wants to buy that either. And you're going to convince them that you can make a profit. No one wants to buy a pig in a poke. They don't want this thing that's going to be a drain. So those are my thoughts on the financial picture. It gets kind of, we see more ugly than we see pretty. We just do. That's, you know, because we get to, people are more honest with us at that point because they have to be, because these numbers have to be due diligently verified. So if we communicate a lie, it's just going to blow the whole thing up. You said this, you said that, none of it's true. Is that true? All of that's true?
John, that EBITDA number, what do you look at in the industry? What do you think are good support resistance numbers on that for oil companies?
Well, I gave you the range, and it really comes down to the quality of that particular company. Does that answer the question? I mean, it's really a 3.5, maybe. It might not even be 3. It's 3, usually 3 plus up to, like John said, you get lucky. Now, I look at 2 things. You know, I like to value my clients using every possible way I can. I do the asset approach, which is what I explained to you a few minutes ago. Then I do the EBITDA approach. And then I do the gross profit approach. So the multiples for me, gross profit times 1, or a little less than 1 actually. Gross margin, which is a whole other number, which is just to do definitions for a second. Selling price of a gallon of oil minus the cost of a gallon of oil is margin. Minus other expenses, direct expenses, delivery, payroll, that becomes the gross profit. So, and margin is a real favorite number of mine over the last 30 years. So I try every method I can. And then there's a bunch of statistics out there that I can access that sort of do, just to test my numbers. But those numbers that are out in the world are old. I mean, 2010, 2011, 2009, and then you think, 2006. I mean, there's not a lot of public information about your industry. And even the IRS, you'd think that they'd be able to suck out good numbers, but their numbers are as good as anybody's, which aren't that great. The best numbers are the numbers that I get in my own office, in my own time, my own way, for my own reasons. Someone needs a valuation, someone needs a sale, John has a sale. You know, we are always testing those numbers. That's the beautiful thing about working with these guys, is we can always, we just check with each other. Does this seem reasonable? If he called me up, he says, you think I can get 11 times EBITDA for this? I go, absolutely not. And then 2 weeks later, he called me and said, I got 11 times EBITDA for this. How did you do that? I don't understand. And he said, we know. Yeah, he didn't know either, yeah. It was just the way it was. I want to talk about accounts receivable. Buyers and lenders, they want to see the aging. They want to see the aging. They want to know how good your customers are. And if you've got a whole bunch over 90 days old, or 120 days old, or 180 days old, you either need a really good explanation, or it shows that you're a really poor manager, or
you dress nice.
Or you have a good story and look pretty, yeah. Now, I'm not saying that everything over 120 days or 180 days is garbage. I'm just saying that you have to have a good reason for it. Now, I have one client that I'm working with, a small company. He has some pretty big numbers over over 2,400 days old. And I said, what is that about? Actually, let me think this. 1,500 days old. And I said, what's that about? And he said, well, I don't want to sue them until the 3 years window has gone by, and there's interest accruing, and then I go to small claims, and I usually get all the money. I thought, okay, well, you know what? You ought to take them out of accounts receivable and stick them into some other off-balance sheet place. Because the buyers are going to look at that and go, you're full of crap. And I said, so you need to explain every one of these items. So I got the little list, and it was a small list. And it was interesting because one of them, the biggest one, it was a big number, was a commercial account that he had in claims and all this kind of stuff. So, but if you take that out, that's what people want to look at.
John, can I have a
Sure.
question? We're on the second line, the second statement. Clean out the old accounts, send them to collection.
Yes.
And if you ask various experts about that line,
Yes.
as to what is legit and not legit, and writing it off, you'll get all kinds of things like, speak to a lawyer. You can't write this off unless you have proof that you're suing the person and going to court. I mean,
Even
that's
that might
extreme.
not be- No, you're talking about tax
What's the rule on
rules.
this out of the
Yeah,
1,000
I
pages?
know.
of,
But let's be realistic.
how this
There's tax rules and there's realistic rules.
Okay.
Tax rules say that you can't write off something until it's absolutely uncollectible and you'll never ever collect it in your whole life. All right, you know what? I'm a CPA and I have to make up a financial statement that looks somewhat reasonable. They changed the rules, the IRS, I don't know, 10 years ago about allowance for doubtful accounts. You used to be able to use a percentage and all. They don't like that. They want it to be direct write-off. And I don't completely disagree with that. But on the other hand, when I send it to the lawyer, to me, it's like, okay, so this is off my balance sheet. This is going. Now, whether that number agrees with the financial statement, because you can have different things for tax return versus financial statement, which, if you're in business, and most of you are, that's a good conversation to have with your CPA. What can I do different on my tax return that I can't do, or I can do on my financial statement? Depreciation is a good example. Those tanks, I said I'm writing them off over 5 years, that's a tax return. Financial statement, I can go 20 if I want to. It's a real useful life. I can write them off so slow that they don't even look like they're being written off. Accounts receivable is another one. You know, for financial statement purposes, you may want to get rid of it to clean up the balance sheet. But for tax purposes, maybe you can. I try not to, Jim. I try not to make a big federal case out of documenting whether this is collectible or not. Because once it goes out, as I say, clean out the old accounts, send them to collection. I want them off that balance sheet if I'm trying to dress up my balance sheet. And maybe you take the hit, and it's a separate line item, and you put it down below, and you say to the bank, you know, right there, it says right there, bad debts, cleaned up. I don't, it's your financial statement. And don't forget that. It's your statement, not the CPA. It's yours. You can say what you want to say on that financial statement. You want to put a footnote in there all about how great 2013 was, you can do that. You want to put a footnote in your financial statement and say, these are my gallons for the last 2 years, you can do that. This is your statement, not the CPA. And people don't know that because the CPA comes in on the suit and you're thinking, he knows what he's doing. Well, you know what? It's your statement. It's yours. They may want to dress up your language. They may want to look, to look a certain way. I mean, you can't do something that's not an acceptable accounting practice or tax practice, and they're not going to sign off on it. But it's your financial system.
But could you take that whole line, say 120 days or 180 days, and write the whole thing up? Because if you do collect it and you keep on trying, you get
no, not 120, not 100.
Bad debts recovered.
You need to look at that list and say these are no good. I have to send these to collection. These guys are bums. They rip me off. I'm mad. They go into collection. I would write them off.
So that's when you're going to write them off?
Yes.
Okay.
I mean, if they're still good receivables, I'm not going, and I have a reason why I'm carrying them because they're still good for this reason, that's okay. Now, the other thing is, just because you wrote them off doesn't mean they're gone forever. And if you do collect them, right here, all recoveries are income. So all of a sudden, you wrote this thing off, you took the tax deduction, you took the expense, but now you get a check for, $3,000 from somebody that you were going to just a little kill because he didn't pay you.
Right.
So now it comes in as income, so it makes the income statement look even better. And they usually offset, you'll see net of recoveries and all this kind of language. So, and I put this last thing in there, move them to a new company on the system. I mean, you don't want to lose the damn thing. You don't want to forget about them. You want to keep pounding at them. You still want to send them you know, aggravating letters and things like that. So, so I say you can move them onto another new company within the system. Because the systems we have these days are fantastic. Even if it's QuickBooks, you can shift them over there. Equipment. Well, personally, I'll go easy here. Get rid of the toys, take them off the books, because if you're going to sell the company, those don't help. You know, you got all these assets, you got, you know, all these fixed assets in the books, and then you go and look at it. I had one client that had a Corvette, 57 Corvette in the garage, the company garage. He had a brand new 2008 Camaro, still had the stickers in the window, you know, 6 miles on it. Those kind of toys. I mean, they're fun to have, right? They're our toys, I know that. We all have them. But they don't need to be on the company books. And they only cause problems if you ever do get audited, knock on wood. Get rid of the junkers. Every time we're doing a potential sale, it's the same old thing. Well, I've got a $1 million company, I have 4 trucks, and the newest one is 1985. And you think, okay, so that's a good truck. It's got good tires on it. The engine's been overhauled. The tank is new. Okay, I get it. But what about the other one that's got the flat tire and it's sitting there like that? Well, we use that for storing something else. And then I have my tool truck. I have my service vans. I have my installation truck. And I got my pickup truck. And then I got my son's pickup truck. And my wife's Mercedes and my girlfriend's Jaguar. And it goes on and on and on and on. And we say, you got to get all this crap off the books. And then, and then spare parts and the inventory, which I don't even think I put up here. I mean, are you kidding? I mean, I know how we are with toys, but are you kidding? I mean, you go in the storage tool, parts department, and, I know we don't like to throw stuff away, but you're not going to be able to sell it. And then you're going to end up with $42,000 worth of old radiators, valves, nozzles, and other stuff. And you tell me what you're going to do with it. Junker's going to come and give you 5 cents on the dollar for it. And then, of course, keeping the trucks clean. Keep the trucks clean, keep the yard clean. That's a big deal with me. That's a big issue with me. Is you want to be proud of your company. In a proud company, tell. I mean, if you were just standing on the corner of a busy intersection and watch the trucks go by, you can tell the nice companies from the okay and oh, that's nice, not so nice. Whether it's the van or the oil truck. I could get into a whole bunch of stuff, but mostly that's my opinion about this. And then I have this screen of choose your competition. What do I mean by that? Because even John said, what did you mean by that exactly? It's the same thing like about the trucks. You want to mimic the quality company in the area, or do you want to mimic the discounter? Do you want to? I mean, if I came to your neighborhood and I said, and I looked around, and I would want people that I know from that area to think, oh, that's a nice company. Oh, he's a nice guy. They're good people over there. They do the right thing. They do, and that's what this particular screen is about. You should be the company that people are emulating. Now, I do understand about prices and all that kind of stuff, being competitive and all that, but there's tiers. I mean, there are tiers. And a good quality company has the respect of the community, and that's really what this screen is about. And when we go into a company, if as a broker, if a quality company goes on the market, we start to almost salivate. I mean, you're like, oh my God, that's such a nice company. It's going to be so easy to bring it to market. And then we hope that we're right. I mean, sometimes the image isn't exactly what the reality is, but usually it is, because you can almost tell. You can almost tell. And then it's a line at the bottom. When you're checking prices, and there's lots of ways to check these days, you have to be careful of some of that. You focus on the better companies, or you focus on the one truck operator and the discounter. The dirty company, the one with the lousy yard, the one that's got the big fence up, because if you looked over the fence, you'd be disgusted by what you saw. I mean, is your facility clean? Is your sign nice out front? Is the yard, when you pull in, a nice place? You walk in the front office, is it attractive? I mean, it's like going to any store. You walk in, and is this facility, is this office, you know, are the people nice? It's all part of the same thing. You listen to the people on the phone when they're talking to your customers. A retained customer is worth a lot more than a new customer. I mean, a lot more. Someone said recently that to get a new customer costs, did we say $1,000 or something like that at the conference? It was a big number. I was like, wow, well, if a new customer is worth $1,000 and an existing customer is worth a lot more than that. And it goes back to screen one, you know, making those customers quality accounts. Let me do this. Joe's going to be right on my back. Then there are taxes. Saving taxes increases value. Now, this contradicts what I said a little while ago. You can't just write off everything and have a loss because you're trying to create taxes. But on the other hand, there are, you know, don't throw taxes away. And one of the ways is this retirement plan. Now, I'm not a retirement plan expert. I am not. But I do know from firsthand experience and all the other things I've done that retirement plans means that you get a deduction for the company and save taxes, and you personally don't pay taxes on that money until you retire someday. I mean, that's a pretty good deal. In my company, I have a thing called the SEP IRA. I can put up to $40-some-odd thousand away just for me and not pay taxes on it until I retire in the next, whenever that's going to be. That's a pretty good deal. And then the type of entity is also a big deal. This is not a simple concept, C corps or pass-through. And I wanted to just list the pass-throughs because they're multiple things. Pass-through is these things: an S corp, partnership, a limited LLC, or business trust. Those are pass-throughs. That means that the company's profit and tax burden falls on me as the person, as the owner of that company. And I show you this because the next screen is startling. And so I'm going to show it to you. I did this math for an article that I wrote already that's going to be in Oil and Energy next month. But the C Corp column or the pass-through column. I sold this company, or I was going to sell this company, and the gain, it was a small company, 1 million gallons or so. The gain on the sale was $440,000. Now, in my article, I explain where I got that. It's the customer sale, the equipment sale, and then I have basis, which means that's my cost and tax stuff. But the bottom line was, somebody's got to pay taxes on this sale, and that's the number they're paying taxes on. Now, a C corporation pays its own taxes. It pays its own taxes. It's like a person, you know. My son wore a T-shirt. He's a liberal, and it says, "I'll believe a corporation is a person when they hang one in Texas." Okay, Ben. But anyway, so a C corp is a person. It pays its own taxes, and so there's the tax burden. Here's how it goes. Corporation pays this tax. Then there's some money left, and the human being who owns that corporation pays these taxes. And then there's the total tax on the sale, and there's the percentage that they pay. Pretty simple math, right? It's a C corp. That's the way it goes. But if I was a pass-through, here's the gain. This doesn't happen. Here's the tax on the sale because it's a capital gain. And there's the difference. Look at that. You're going to pay this tax. So out of that sale, you human being ends up with $210,000 or whatever it comes to. Under a pass-through sale, you, the human being, ends up with $335,000. So that's why I show that to you. Now, don't go running back and say, S corp, we got to do this right away. There are ways to do it. There's ways not to. There's times to do it. If the children are going to inherit the business, C corp, I don't care. It's okay. It's probably better. I like it. If it's going to be a pass-through to the next generation. If it's not going to be, if Mary says, I don't want to do what you've done all your life, I'm out of here. I don't like this business. It's too hard. Well, then you're going to go and sell it to me, then you've got a real serious problem here. And I just point this out because taxes can kill you. Taxes can kill the transaction. Am I right about that? We've gotten right down the road. It's the first question I ask now, not the last question. But I've been in the closing, and all of a sudden the CPA says, well, here's the taxes that you're going to owe at the end of the day. And it's like, and they say, well, there's not enough to live on. Why would I sell my company? This person makes $100,000 a year. and he's gonna end up with 100 and, you know, nothing. Why would I sell that? I'll see you guys later. And out the door he goes, and he leaves that burden to his wife, or children, or family, which is what Joe's gonna talk about in a few minutes. Common good ideas about, these are some of the ideas that we see in the really nice companies that we go to. Add or upgrade your technology. There's some good stuff out there. We saw Bright the other day, which was phenomenal. I couldn't believe it. Gary Sippen's got a great product. There's West Rock. That's not Gary's company. Have a web presence. You have to today. You might not like it. It's more of the younger generation, but if you want to stay in business in the next 5 years or 10 years, then you're going to need a web presence. People want to order online, they want to pay online, they want to communicate online, they want to bitch at you online, and you better not ignore it. My kids, and I have several, this is how they live. It can be texting, it can be apps, it can be, you need a web presence, you need a way for that customer to communicate, and you need a person, a customer service person, CRS, customer CSR, they need to address this. And then pay off the debts as fast as you can. That's another thing. Nice companies don't have a lot of debt. They try to get rid of it even at the expense of not taking as big of a paycheck. Set up a leasing company, which is a separate conversation, which we could have. So get the real estate out of there. If you're going to buy new real estate, don't put it in the company. Outside the company. Real estate inside the company is a bad, bad, bad idea. You can't get it out. You can't, if you sell, there's a huge gain, and it's going to be taxed twice, like we said before. And increase the value of your existing assets, add new assets, and eliminate debt. And I hope that's me, and then this is going to smoothly go into Joe's face, and there we go. Thank you.